Hey everybody, it's Antoine Martel here, and in this video, I'm going to be sharing with you the ultimate beginner's guide to investing in real estate. So if you're just starting out, this is the video for you. And there's many different ways to invest in real estate. So when I talk about real estate investing, I mean buying houses, renting them out, and holding them for the long term for cash flow every single month. But before we get into the video, I want you guys to please smash the like button and subscribe to my channel so that I can teach you every single week on this YouTube channel different ways to invest and how to get started step by step. And keep in mind that all the advice that I'm giving you guys along the way is stuff that I have taken and stuff that I am doing currently in the real estate market. So if that's what you're looking for, let's dive into the video. Step 1, building credit. So building your credit score and having good credit is important to investing in real estate because most people, when they invest and buy rental properties or buy real estate in general, get loans. In order to get loans on these rental properties or real estate, you have to have good credit or else these banks will not give you any loans. If you have bad credit, then banks will charge you high interest rates, high points, high fees. If you have a really high credit score, then banks will give you really good terms, 30-year terms, 30-year amortization, really low points, fees, and really low interest rates. The lower your interest rate and the lower the fees means the more that you can pay for these properties because your cost every single month will be way less than if somebody had a very bad credit score and your interest rates are much higher, which would affect your cash flow and your purchase price. So essentially, the higher that your credit score is, the more money that banks are willing to lend to you at a lower interest rate. Which theoretically means that the higher your credit score is, the more money that you can save on these rental properties and more money you can make every single month when you go out and buy rentals. So the minimum credit score that I would recommend getting to is 680. The reason why is most banks will not lend to you if you have a credit score below 680. Also, if you're trying to get conventional financing, 680 is kind of like the minimum target that most banks want you to have if they're going to give you Fannie Mae or conventional financing. So if you have a credit score below 680, you do have a couple different options. These lenders will be more like hard money lenders or asset-based lenders. The rates and terms and fees and interest rates will be way higher, but you can still get started today. Go buy a couple rental properties, then once you get your credit score up, you can go and refinance and get cheaper money. The optimal credit score to get to would be 740. Once you hit a 740 score, then most banks, most lenders will give you the best rates, best term, lowest interest rates that they possibly can offer. And working on your credit and getting your credit score to 740 or greater literally makes you money every single month. That's why it's so important. Because if you can get your credit score to over 740, the interest rate's going to go down significantly, which saves you money every single month and makes you more money on these properties every single month. Another important thing when you're applying for loans and getting loans on these rental properties is your debt to income ratio. So besides credit, banks will also look at your debt to income ratio, how much debt you have versus how much income you're making. The reason why is banks don't want to give you a loan when you are already breaking even. So if you're making $1,000 a month and spending $1,000 a month, if I'm a bank, I'm not going to go and give you a loan for $500 a month. You don't even have the income to support that. So in addition to your credit, make sure that you don't have too much debt, too much student loans or car notes or anything like that. If you do, make sure that you have the income to support it. Make sure that you have the income to support the additional debt to go and buy rental properties. Another piece of documentation that the banks will require to get a loan to buy any kind of real estate will be 2 years of tax returns. Now what the banks will do is they'll look at your income for the last 2 years on these tax returns, and that's how they'll come up with your debt to income ratio. They'll actually take the income from the last 2 years that's shown on your tax returns. So something to note is that if you don't have 2 years of income, you only have 1 year, or you just started a new job, it is going to be quite challenging for you to go and get financing on these rental properties if you don't have 2 years of really good tax returns. So with that being said, keep in mind if you own a business or if you're trying to write off a ton of stuff on your business tax return or personal tax return, just keep that in mind. If you are trying to buy some rental properties in the next couple of years or even right now, just make sure that on your tax returns, you're not writing off too much. Because what the banks will actually do is if they see you make a loss on your business, but you own that business, they'll take that against your income. So it can be very challenging for somebody like me who owns a real estate business. We write off a ton, we're buying all these assets, doing a ton of depreciation, but we have really good income. On our tax return, it shows that we're losing money, but on our personal tax return, we're making money. So the banks will actually come and look at us and be like, wow, you have a business that loses $1 million a year, but you're making personally $100,000 a year. So they're going to look at it and say, wow, you're negative $900,000. We can no longer give you a loan. So just keep that in mind when you're setting up your business and paying taxes, that you don't write off too much. So now that you have your credit score in order, the next step is to save up capital to be able to put down 20 to 30% to buy these rental properties. One of the amazing things about the real estate asset class is that you're able to get financing to buy these rental properties. Unlike the stock market where you go and buy stocks and you buy $100,000 worth of stocks, you need $100,000 worth of cash. But the great thing about real estate and the great thing about rental properties in particular is that to buy a $100,000 property, you only need to put down 20 to 30% or $20 to $30,000 and the bank will finance the rest. So one thing to keep in your mind is when you're going to go buy these rental properties, that $20 to $30,000 has to be seasoned in your bank account for 2 months. So that means, for example, let's say you're going to go buy property next month and you get a random gift from Joe. Joe gives you $20,000 and $20,000 just randomly appears in your bank account. Now you're going to take that $20,000 and go buy a $100,000 property. The bank is going to look at 2 months of bank statements and say, hey Antoine, we see you got a gift of $20,000 from Joe. What is this for? Oh, that's just a random gift. The bank is not going to allow that and won't allow you to use random money just showing up in your bank account to go and buy rental properties. So make sure that when you're ready to go and buy rental properties that you have money seasoned in your bank account for 2 months or more, because the bank will only ask you for 2 months of bank statements. So if Joe gave me the money 3 months ago, I would be totally fine. So there's a lot of books and a lot of YouTube videos about how to invest in real estate with $0. Personally, I think it's very, very challenging unless you're doing like wholesaling or house hacking or something like that to invest in real estate with hardly any money. I personally think that to invest in real estate, you will need a little bit of cash liquid. Even if it's just a couple $1,000s to get started, I think having that money is going to make your life a whole lot easier. So if you don't have that $20,000 to $30,000 now, continue saving, start putting money from your paycheck every single month into your bank account and start holding that cash to get to that $20,000 to $30,000 range. So now that you have the down payment ready to go, it's time to get pre-qualified with a lender. And I would highly recommend shopping around. So go talk to 3 to 5 different lenders, ask them what their minimum loan amounts are, the points, the rates that they're seeing, the minimum credit score, all those kinds of things. You will find that if you're buying properties in the $100,000 to $150,000 range, many lenders won't lend below $100,000. So you will have to do some shopping around at the very beginning because you'll have to find lenders that will lend below that $100,000 minimum loan amount. And when you're in the process of going and getting pre-qualified with 3 to 5 different lenders, don't be scared that they will pull your credit. So the credit bureaus actually, if you have a 30 to 60 day window, you can go and talk to 10 different lenders. They can all pull your credit score 10 different times and it only will count as once. And when you're getting pre-qualified, you don't have to just get pre-qualified by one lender. Go get pre-qualified by 5 different lenders, 3 different lenders to really make sure that they give you a legal document about the interest rate, minimum loan amount, terms, fees, all those kinds of things that will help you go and analyze your deals later on. So when it comes to getting pre-qualified, I do have a little ninja tip. My ninja tip is to use a lender called Kiavi.com. So the great thing about Kiavi is that they have an online portal that can get you pre-qualified for any kind of loan in just 5 minutes. So essentially what you can do is you can go to their website, plug in some information, make up a random property, and it will give you a pre-qualification letter. It's just a really quick way to get a pre-qualification letter so you can start making offers right away. They also don't do a hard credit pull, they do a soft credit pull, so it won't really affect your credit score at all either. The next step is to find a city to invest in. So one of the biggest questions that I get all the time for the last couple of years is what cities should I invest in to buy rental properties, to buy real estate? And because I got this question so many times, I built this website called investor-list.com. Because when looking at a market, there's many different websites that give you data and there's no one central database that pulls all this information into one central website so you can look at all the different things you should be looking at to invest in a new market and invest in a new city. So some of the things that you should be looking at are population growth, job growth, who the major employers are, what's the unemployment rate, how many people are moving there, what's the median home price, the median rent to value ratio. And over the last couple of years, there wasn't one central website that had all of these different things. So we decided to build it. We take a lot of the data from the Census Bureau and BLS.gov and put it all together in one central website so you can apply some filters and find some great markets to invest in. Another good thing that you should do is follow some big fish. So follow some people like myself that are investing across the country. Look where I'm investing, look where other people are investing, and start following these people that are buying in different markets across the country. In a lot of my content, I talk about why I invest in the cities that I invest in, and many other content creators and real estate investors out there talk about why they chose the cities that they're currently invested in. You can take some of that information and start looking for similar cities that match those criteria, or just investing in the cities that we're currently invested in. So when I first started investing in real estate, I had no idea about anybody who lived across the country. I grew up in San Francisco. I lived in Los Angeles for the last 6 years, so I didn't know anybody who lived in any single market across the country that would be good to invest in. But maybe you do know people who live in Memphis, or you have a relative in Cleveland, or you have a family member in St. Louis. These could be great places to begin because you already have that foundation. You have somebody with that local knowledge that knows the market. They may know a realtor friend or have a property manager friend, and you can start leveraging those connections that you already have. For me, I had to choose a market just based on a lot of data, and I had to start cold calling. I started cold calling realtors, property managers, and started building that team from there. So now once you've chosen your city, it's time to choose the neighborhood that you want to invest in. And the way that I go about this is by leveraging that local knowledge on the ground. So whether that's a friend or a realtor or a property manager or whoever you have now on the ground, you want to start leveraging that person and asking them which neighborhoods that they would recommend you buy rental properties in. So I have a couple of criteria when looking at the right neighborhood to invest in once I've found the city. I like to invest in neighborhoods that have low crime, that are close to jobs, and that are also close to downtown. So I don't like to invest in neighborhoods that are an hour away from downtown with low jobs where people have to commute long distances and in places that have high crime. One of the other things that a lot of people talk about is investing in good school districts. This is something that I found that really increases the price of the homes, but doesn't really increase the rents of properties in those neighborhoods. What I mean by that is, let's say you find a neighborhood where you can buy a house for $100,000. A couple streets over, it could be a completely different zip code and completely different school district, and that same house will sell for $200,000 to $300,000. But the rents will be fairly the same. So I prefer to invest in the $100,000 neighborhood, even though it may not have the best school district, just because it helps my return. I also like to invest in neighborhoods that are close to downtown. So normally my neighborhood's around 20 to 30 minutes outside of downtown. I think this just helps with the proximity to jobs, the closeness. People are also just a short drive away from restaurants, bars, and all those kinds of different things. One of the things that I really love is finding some of the best zip codes in a new city. Then you take those best zip codes and you try to invest on the fringes. So where does that good neighborhood tend to lead into a little bit rougher part of town? I like to buy properties on that couple of block radius from the good neighborhood to the rougher neighborhood. The great thing about investing on these fringes is that you can buy a $100,000 property close to a $300,000 neighborhood, and slowly over time, as that great neighborhood starts to expand and expand, your home value begins to go up, rents begin to go up, and new people start to move into those fringe areas because the really nice part of town got too expensive. So the next step is analyzing deals, which is the fun part. So if you're just starting off and you don't have any deals to analyze and you want to get some practice in, and you also want a free deal analyzer spreadsheet, head to martelturnkey.com. Once you go to martelturnkey.com, you'll see a bunch of properties available. Click on the Turnkey Rental Properties for Sale button. Then click on any random property, and in the top right-hand corner, you'll see a button that says Download Financials. It'll give you access to an Excel spreadsheet. Download that Excel spreadsheet and use that as your deal analyzer. That Excel model that you see will be already a deal that we have on our website analyzed, but you can take that Excel model, change the numbers, go find a random property on Zillow, Redfin, Trulia, change the numbers, change the address, the bedroom bathroom count, the rent, the taxes, the insurance, change everything about it, but the deal analyzer spreadsheet will be a great tool for you to use when you're going out there and analyzing deals. Also, looking at martelturnkey.com could be a good barometer to start looking at. Whenever I'm analyzing deals, the main thing that I'm looking for is cash on cash return, and you should too. Now, cash on cash return is your annual pre-tax cash flow divided by the total amount of cash invested. So if you see deals on martelturnkey.com for 10, 11, 12% return on your money, then when you're out there analyzing deals, don't find deals and don't buy deals with 8, 9, or 10% returns. You want to go and find deals on the MLS, on Zillow, Redfin, Trulia with 10, 12, 13, 14, 15% return on your money. Because at the end of the day, you can just go to martelturnkey.com and buy these turnkey rentals and get 10 or 11% return on your money. So if you don't want to use a turnkey provider and you want to go and put in that extra elbow grease to do it yourself, to choose a new market, choose a city, build a team, analyze deals, make offers, get financing, if you're going to do all that work, you should be getting a higher return than Martel Turnkey can already offer you. So once you've found your neighborhood and you start looking at deals, I would recommend analyzing a high volume of houses. This is going to be really, really great practice for you so that when you do find a unicorn deal, when you do find a really, really good deal, that you can pull the trigger quickly and easily because you have already done all this research about this neighborhood and you know it's a good deal. So I would recommend analyzing deals that are rent ready, move in ready, seeing what kind of returns you see on a consistent basis. So that when you start analyzing these deals and you find a house that's renovated, stainless steel appliances, nice flooring, new paint, new kitchen, new bathrooms, and that makes a 13 to 14% return on your money. When you finally analyze a deal that has a 15 to 16% return on your money, you can pull the trigger right away and be ready to go. So I would highly recommend finding properties that are move-in ready, that are vacant. I would not recommend buying properties that are already occupied. This is called inheriting tenants. When you buy a property that already had a tenant who has lived there for 2, 3, 4 years, this can kind of get very, very messy when you move property management companies or it goes from a mom and pop landlord to a professional property management company. Sometimes the tenants don't like it and they start not paying rent, and now you have to go through a full eviction process. So when you're analyzing these deals, you're gonna have to come up with a market rent for these properties that you're analyzing. One of the tools that my team and I use is a website called rentometer.com. So with this website, you'll be able to take the address, plug it into the website, click how many bedrooms and bathrooms it has, and it'll spit out a median rent for that property. Now I would use this number for my analysis, and then later on, once you're under contract on a property, send out the property management company to verify this number. So I would find houses that have professional photos. I would find houses that haven't been listed on the market for too long, maybe just 30 days or less. I would find houses where the kitchen is renovated, the bathrooms are renovated, and everything looks nice, clean, and livable currently. The other benefit that this has is that when you go and try to get financing on these properties, banks are way, way more willing to lend to nice, clean, renovated properties than old, dilapidated houses that probably aren't even in livable condition. So now once you've analyzed a ton of deals and you have a good baseline, it's time for you to start making offers on these properties that you're finding. So the way that you make offers on these properties is through a realtor. But if you're first getting started in a new neighborhood, you probably don't have a realtor in that market. So let's say you're analyzing deals consistently on a consistent basis. You'll start seeing the same realtor appear every single day, week, month. You want to start reaching out to that realtor and all the realtors in that neighborhood that are listing properties that are similar to what you're trying to buy. Through these conversations, you want to let these realtors know who you are, what you're trying to do, that you want to buy these properties, rent them out, and see if they have any recommendations for you. When I first started making offers, I probably had to cold call close to 200 realtors before I found a really, really good realtor that was going to help me buy houses, clean them up, and then rent them out. But if you're going to buy something that's already been fully renovated, you can just contact a listing agent on Zillow and Redfin. Call the listing agent, ask them about the property, see what they think the property would rent out for, ask them if they have anybody or anybody that they know that would be able to manage that property for you. So before you're ready to move on to the next step, make sure you have a great property management company on the ground to manage these properties after you close. So property managers are the key to having a great and successful real estate portfolio across the country. Without property management companies, I would literally not be able to do what I currently do today. There's a couple of great ways to find local property management companies. First and foremost, I would ask your realtor that you're currently working with for some recommendations. Sometimes these realtors even work very closely with property management companies because they're currently doing the same thing already. They're already working with out-of-state investors that want to buy rentals, and they already connect them with local property management companies. So after you've submitted a couple dozen offers, you'll finally get an offer accepted, and now you're under contract on your first property. The under contract period is the most important period and the most important step of this entire process. Throughout this period, you'll be able to make sure that you're actually getting a good deal. So yeah, your analysis could have shown a 20% cash on cash return. You'll be able to actually verify that. So now that you're under contract on this property, it's time to start sending in your team members throughout the property to make sure the house is sound and is still going to be a good investment for you. There's going to be a couple groups of people that I would send through the property. The first is the inspector. Second is the appraiser, and third is your property manager. So the first person that I would send through the property is going to be an inspector. This inspector is going to be a third person party. This person is going to be a recommendation, hopefully from your property management company or realtor, or you can find them online. You're going to send out this inspector to the property, and they are going to make sure that the house is structurally sound and doesn't have anything wrong with it. Now, a lot of people ask me if I currently get inspections on all my properties, and I don't right now, but I would recommend for your first couple of properties when you're in a new market to get an inspector to go through the property. So when you send an inspector out to a property, their job is to find stuff wrong with the property. So don't be alarmed when the inspection report comes back and stuff does show up or appear on the property inspection report. Stuff will always show up on the property inspection report, so do not be alarmed. Now let's say some major items do come up on this property inspection report. The sewer line is busted, or the bathroom is leaking, faucets are leaking, roof is collapsing. You're probably going to want to send these things to the seller and the seller's agent and see if the seller and seller's agent will take care of these items for you before you close on the property. The second person that I would personally send out to the property is going to be the property management company. The reason why I like having the property management company walk through the property is they can verify what the property will rent out for once you close. So let's say in your analysis you had $1,000 a month in rent. You want to send out the property manager and make sure that they think they could rent that property out for $1,000 a month after you close. You can also ask the property management company if they would recommend any repairs to get the property rent ready to get the highest possible rent in that neighborhood. And if the property management company does recommend some repairs to that property, typically they can get a bid for those items. And this is the point where you may be asking, Antoine, what about contractors? Is this when I send a contractor out to the property to get a scope of work? Is this when I send 3 contractors out to the house and then look at all the bids and see which one is best? And the answer is no. I would not recommend looking online or trying to find a contractor on Google or Yelp. I would not recommend going and finding and managing contractors from afar, especially on your first deal. You really want to have this local team on the ground do that work for you. So even if it's a small little item that the sellers won't take care of, just ask if the property manager can do it, or ask if the realtor knows anybody that can handle that small little item. Typically, property management companies do have contractors on staff or on payroll that can do quick little fixes on properties called unit turns. So typically they have a couple of different contractors or GCs that can handle these items, and they can get you some small bids to handle items to get the house rent ready. The third person that's going to walk through the property is going to be the appraiser. Now the bank, in order to give you a loan on the property, is going to request that an appraiser walk through the property to verify the house is worth what you're buying it for. Essentially what you'll do, you'll just have the appraiser contact your realtor. The realtor will set up a time to walk the property with the appraiser. There's not much information that you can give to the appraiser to help sway their decision. They're essentially just going to walk through the property and make sure that you're buying the property for a good price and you're not overpaying what the property is currently worth. So now that you're under contract on a property, you want to verify that rent amount that you found on Rent-A-Meter. The way that you do this is by sending out the property management company to that property, have them walk around it, take photos, and have them verify that they can rent out the property for what you found on Rent-A-Meter earlier. So while you're under contract on a property, let's say you're buying it for $100,000 and the appraisal comes back at $80,000. What do? So for a lot of newbie investors, they think that they still have to buy that property for $100,000. So they have to put the 20% down, plus they have to split the difference and come up with the extra $20,000 from the $80,000 appraised value to the $100,000 purchase price, and that is not the case. Do not do that. You should only be buying properties for their fair market value. So you really should be buying that property for $80,000. And if the property does not appraise, you can just walk away from the property, you get your earnest money back, and you can walk away with no scars. The next step is to close on the property. So once you have a successful inspection, appraisal, and the property manager walked it and verified the rent, it is time to close. So you did it, congratulations. So the whole process from getting the property under contract to closing should take you around 30 to 45 days. So on the day of closing, there's a couple of things to keep in mind that I want you to do as soon as you've closed on that property. First and foremost, I want you to make sure that you contact your insurance agent to make sure that you have insurance effective the date of your closing. The second thing is you want to let your property manager know that you have now closed on the property. Then the property management company can set up the portal for you, add that property to that portal, and then they can also start doing any of the cleanup work that is needed to get the property on the market for rent. If no work is needed, then that property manager can just go and take photos, list the property up for rent, and start marketing for a tenant, because I want you to get a tenant in that property as soon as you possibly can. And I would highly recommend sending out a professional photographer. Even though the property may only rent out for $800 or $1,000 a month, I think that really getting a professional photographer out to that property can help drive more leads to the property and get you a better tenant. So once you have the professional photos and that property is being marketed for rent, you want to make sure that your property management company is blasting the property on many different websites. There's so many different websites out there where you can find houses for rent. You want to make sure that your property is listed on many of those websites. And most professional property management companies already have a system or a tool that will take your property and blast it to 30 websites. So just make sure your property management company has a professional property management software and portal, and they're blasting out the property to many different places. So hopefully a couple weeks after closing, the property is now occupied. So hopefully your property manager, after you close, took some professional photos, found you a great tenant, and hopefully within 30 days after closing, a new tenant has moved into your property and signed a brand new 1-year lease. And that brings us to our next step, which is my favorite step, which is watching the cash roll in every single month. So now that the property is currently occupied and you're making a couple $100 a month, you can take that money, roll it into more properties, save up for the next down payment to continue to grow your real estate portfolio. And it all goes back to having a great professional property management company, making sure that they're managing that property correctly, making sure that the property management company is managing the tenant and managing all the maintenance tickets that are coming in from the tenant as well. And hopefully within the next 15 to 30 years, that house is completely paid off. You're sitting on a beach, drinking Mai Tais, smashing that like button, and subscribing for future videos. So now that you made it this far in the video, you really know a step-by-step guide about how to buy your first rental property. Now, don't make it any more confusing than it needs to be. So keep it simple and don't overcomplicate things. There's so many different ways to invest. Just keep it simple and follow these exact steps to make you lifelong wealth. Thank you so much if you made it this far in the video, and I'll see you on the next one.